hopefully everybody now is connected and can hear as well. Last week we have our first webinar. I think it went very well. We get a lot of good feedback from you. Shiva Rajgopal did a fantastic job with presentation. So hopefully our next webinars will be as good. So today we are very happy to have our own DJ Nanda talking about CEO turnover sensitivity based on performance. And I will give a word to DJ in a minute or two. Before we do that, let me just quickly go over the upcoming seminars. So next week we'll have Bill Mayo, and then the week after that Christian Lloyds, and then Brian White and Jennifer Bluey. So all of this information is posted on our website, and we'll keep updating it. Also, let me quickly remind you the rules of the webinar. So speakers have approximately 20 minutes to present their research, and then we'll use the next 40 minutes or so for the Q&A session. If you have any question, please pose a question on the general chat, and then I'll give you an opportunity to ask your question. Also, just to minimize the audio noise, please unmute your microphones. Mute your microphones and unmute them only when you ask questions. Well, thank you very much. With this, I'll give the DJ opportunity to present his work.
Roman, you want to stop sharing and then I'll share mine?
Here we go.
Okay. Let's see. Here we go. Okay, good morning, good afternoon, good evening to our second webinar. So before I get in, I just want to wish everybody a happy Easter, happy Passover. It's a holy week, and we have people all over the world. We got people tuning in from Australia and Hong Kong and all over the US. So wish everybody a happy Easter, happy Passover. So before I get into the paper and describing what we do, this webinar series, I didn't realize we are reaching more people with our research quicker than we've ever done before, because you can see how many participants we reach. So it's an amazing way of disseminating information. We have people, not only academics, we have people from industry, and we have people, former students. We have somebody who was a former student of mine 22 years ago who's tuned in. So it's actually pretty amazing, the reach. But most importantly, this allows me to appear completely professional while not wearing pants. And I am really enjoying this. This is, kind of a great way to spend my day. Okay, so what is this paper about? This paper is co-authored with Miguel and Rosie, and now in the digital world, we're all going to have our acronyms. So Miguel is from now on 3M, and Rosie's RX. So what is this paper about? The goat has left Massachusetts and moved to Florida. He's now in Tampa. And the headline around his move is, he leaves big shoes to fill. Okay. We have Bob Iger leaving Disney, and the headline is, Bob Chapek has big shoes to fill. So what does this mean? What does this big shoes to fill mean? And so what I'm going to try to tell you is our research, but I want to start with a very simple story behind this big shoes to fill idea. And the simple story is just this, that if you have superior performance, it leads to higher expectations. And these higher expectations could be for many reasons. So what we're going to try to do is convince you that these high expectations are coming from a fundamental updating of beliefs about the value of an organization. But most people interpret this high expectations coming from following somebody who's a superstar. So the next quarterback for New England Patriots is being compared to Tom Brady rather than to what the Patriots can actually potentially achieve. So these high expectations lead to they increase the likelihood that somebody is going to fail. And then you're fired. Okay, so this ends the CNN portion of the webinar. We had a story, we had vigorous hand waving. We have, now you will see a graph, which is completely cryptic, and we had Donald Trump. Okay, so now let's get back to science. So the story is very appealing in a very facile way, because the story is intuitive, that if you walk into a job following somebody who's very successful, that you'd be compared against them. But why are we being compared against them? So since we are social scientists, we have to get a little sciencey. You know, the past was, what I just completed was at best a New York Times article. So how do you get sciencey? Well, we need math. So I'm going to go through a little bit of math, not very complicated, very simple math to generate hypotheses that we can then test. So verbalization isn't enough. We need some math if we're going to run some regressions. So let's say you have an organization, we call it a firm. Now, this is more general than just firms. The reason we use firms is because we're looking at CEOs. But this applies to whether you're a football team or you're a cricket team or you are a studio executive making movies. So you have performance, which is this VI, and this VI is a function of several things. One is the ability of the CEO, which is AI. Plus, it's also a function of how good the firm is. So if you think about the Patriots, it's not just Tom Brady being the GOAT, but it's also Bill Belichick. It's the training staff, the other players on the team, the organization as a whole. So when Brady leaves, the AI is gone, but the F remains. F is what is the firm-specific persistent factor that goes from CEO to CEO. So if you look at Bob Iger, Iger's gone, but Disney still has Pixar. It has Disney World, and of course, it has the train wreck, ESPN. So they remain, and they have, Bob Chapek is still managing those very valuable assets. So knowing that firm performance is affected by this, we have to impose some kind of statistical properties to this. And so we just assume this F, or this unknown, uncertain, time-persistent factor, is normally distributed with some mean and conditional variation. And this factor remains persistent across periods. So the prior CEO and the current CEO both have this firm-specific value, fundamental value. So what's the model? The model is very simple, that after people observe performance, they are going to update their expectations. How do they update their expectations? They follow Bayes' rule. So my expectation of the fundamental value F, which is M prime, is based on what happened in the past, plus what I previously thought F to be, M. So that alpha is my update factor. And this alpha is very simple. It's essentially the correlation across periods, or the ratio of the variances. So I'll come back to that because it affects the second hypothesis. So as we observe high performance, because of alpha, my M prime moves up. High VI minus 1 means high M prime. As M prime moves up, I'm moving it further right in a normal distribution. So the area below M prime is going to increase. That is, the likelihood that we fail is going to increase. So the expected value of VI after observing high performance is high VI. That means the probability of getting a realization below VI is smaller. What this means is that the board will fire the CEO if the performance is below their expectations. So as my performance standard moves up, the likelihood of getting fired goes up. Okay, so this is a very simple prediction. But there's a second prediction. The second prediction, and this is the counterintuitive part, is because of this. What this implies is that sigma square in the numerator is the uncertainty about the firm. That means that alpha is higher if there's greater uncertainty. So only when uncertainty is high am I further going to increase the likelihood of falling short. So the reason it's counterintuitive is that people think that walking into a big organization is going to result in greater career risk. It's the opposite. If you walk into a young, small, growing, uncertain company, that's where the big shoes to fill is even higher because there's greater uncertainty. And so what this does is, and so, I made fun of journalists, and sometimes, seldom, very rarely, they get it right. And this time in the Wall Street Journal, they got it right. So when they were talking about Tim Cook coming in after Steve Jobs, the writer wrote, he would also have to contend with the sky-high expectations that Jobs had, condition the public to have for Apple, not for Steve Jobs, for Apple. So the updating is happening on Apple, not on Steve Jobs. Steve Jobs is gone. Remember the AIs? Steve Jobs' AI is gone. Now it's Tim Cook's AI. But the only thing that remains is the iPads and the iPhones and the software and the iTunes and all the architecture he left behind. So we have two predictions. The first is that because after superior performance, expectations are ratcheted upward, the likelihood of turnover given any level of performance is higher. So this is the big shoes to fill hypothesis. But the second prediction is that this sensitivity of turnover to performance is even greater when there's greater uncertainty about the organization. Okay, so these are what we're going to test. So what we examine is very simple. Turnover is a function of performance. And our innovation in this paper is to introduce this little beta multiplier, which corresponds to performance prior to a CEO's appointment. So they had nothing to do with this performance. However, it's going to affect the likelihood of performance-related dismissal. Okay, so the first prediction is this beta is going to increase with firm performance prior to appointment. So we have to identify turnover. And so we do several things, but I'll tell you, for the main results, this is what we do. We first identify what are called non-performance induced turnovers. That is death, retirement, and following good performance. So because performance-related turnover is in response to inferior performance, good performance, we should not see a performance-related turnover. The turnover may be voluntary because somebody moved on to greener pastures. Okay. All other turnovers, we then classify as performance-induced. And then in robustness, I'll show you we do other stuff too. So the next thing we have to do is, how do you measure performance? So classically, what the literature has done is they have evaluated the performance of a firm or an executive relative to their peers. And so they create a peer group. You can use industry size, some way of matching a firm to its peers contemporaneously. And then what you do is you do a regression of stock returns for the firm on the peer group. So you take out the systematic component of performance out. What you're left with is this little VIT, which is the idiosyncratic component. That is the amount of performance that cannot be attributed to either general economic conditions, industry conditions, and so on, right? So this is unique to the firm. So that's our main measure of performance. Then we measure past performance. So past performance is the same VIT, but over the previous CEO's tenure. So in the main test, we use the last quarter, but then we add other measures which correspond to longer time windows. I'll come back to that. Okay, so just to validate what we find, we have about 25 years of data, about a little over 2,000 very large companies, S&P 1500 companies. And essentially, the turnover rate is about 10% annually, or quarterly, it's about 2.5%, out of which 1.7% is performance-induced. So a very large fraction of turnover gets classified as performance-induced turnover. Okay. If you look at the performance of firms with performance-induced turnover versus non-performance, you can see that our heuristic for classification works quite well. The firms with a performance-induced turnover have much worse performance with firm stock returns and with accounting returns. The CEOs tend to be a little bit younger and have slightly shorter tenures, okay, but not substantially so. Okay, so what we do is, because we know that tenure plays a big role in affecting turnover, so longer tenured CEOs are more entrenched, they're not going anywhere. We run what are called hazard regressions to account for the tenure. So these are basically just stacked regressions so that tenure is not affecting our relation. And what we find is a negative effect, as we hypothesized. That is, if past performance is good, you are more likely to get dismissed for poor performance. This is both for all turnovers, which is without our classification of performance versus non-performance, and is magnified if we just look at performance-induced turnovers, the 1.7% of the observations. So this is the first result, and this was that graph which I earlier showed you, is that the turnover performance sensitivity is increasing in the prior performance, the performance of the firm prior to appointment. Okay, is this meaningful? Yes, it's substantially meaningful. Just going from the 10th percentile to the top percentile, it increases the likelihood of turnover threefold. So if you take negative 10% return, what is the likelihood of being dismissed? It's going to be 3 times higher if you walked into a firm that had done well versus if you had walked into a firm that did poorly. So it's very, very substantial. Okay. Now, the second hypothesis, instead of going through numbers, I'm just going to show you a bunch of graphs. So what we do is we run the same regressions across small firms and big firms. The small firms, there's much more uncertainty about their fundamental value. The large firms are diversified. They are fairly stable, so there's less uncertainty. And sure enough, our result is only pronounced in small firms. If you look at the shaded regions, those are confidence intervals. And for large firms, the confidence intervals are very large. Even though it's downward sloping, it's not significant statistically. Whereas for small firms, it's tight confidence intervals and much higher slope rate. The same thing with young firms versus older firms. We only find the effect in young firms. Older firms, there's almost no effect of past performance on CEO turnover. But for young firms, there is. We find it when analysts' forecast dispersion is high, also signifying greater uncertainty. We don't find anything when forecast dispersion is low. When forecast errors are high, again, indicating high uncertainty, we find a much higher relation with past performance than when forecast errors are low. So this is sort of all the evidence that supports our model and our prediction. Okay, and then we do a bunch of robustness. You know, we have different measures of performance, accounting performance. We do industry adjustment, raw stock returns, value-weighted peer performance. We look at alternative time windows. So the past performance could be last 4 quarters of the prior CEO's tenure, or the average performance over the prior CEO's entire tenure. We have turnover classification. We also use Genter and Llewellyn and Perino's classification because sometimes turnover is induced because of spin-offs and mergers and acquisitions. So we remove all those turnovers and we get the same result. And then we use a logit instead of the stacked regressions hazard model. We use logits. Okay. Okay. So now, one counter hypothesis is the fact that this is a behavioral bias. That is, or if you want to get sciencey, it's a cognitive bias. That is, people are really not comparing the new Patriot quarterback against what the Patriots can achieve, but they're comparing that person against Tom Brady. So they have unreasonable high expectations, which is going to create mistakes in firing. So somebody's getting fired not because they deserve to be, but they are just being compared in a biased fashion, right? So when are these biased judgments more likely? When the quality of a subject is uncertain. So what we try to do is try to come up with measures of uncertainty in a CEO's ability. So we look at young CEOs versus old CEOs. We look at whether it was an insider or an outsider. The outsider, there's greater uncertainty because there's less known about how they can work with the firm, and whether their prior experience. So inexperienced CEOs there's greater uncertainty about their managerial ability. Okay? We don't find anything. It doesn't matter whether it's an older CEO, younger CEO, insider, outsider, whether there's prior experience or there's no prior executive experience. So we don't find any evidence that this is really a cognitive bias story. It's really a fundamental, rational updating and learning about the fundamental value of a firm. Okay, the other idea is maybe there are some firms which just have a proclivity of firing people because they're just poorly governed firms. So maybe governance quality is related to turnover, because turnover performance sensitivity indicates poor governance. So, and this governance is going to be correlated with past firm performance. So if you're a poorly governed firm, your past performance is also likely to be poor. So what we do is we include a bunch of measures related to corporate governance quality to account for governance quality. We also interact them with performance. The three measures we use is independence, board size, and the busyness of directors. So busy directors are not likely to do a good job. Large boards are ineffective, and boards that lack independence are less likely to remove a CEO. If you look at the orange shaded coefficients, they all remain the same. They are about the same magnitude without these, including these variables. So again, the main effect remains despite including corporate governance. Okay. The other issue is, well, maybe we have serial firings. That is, one CEO gets fired, that increases the likelihood of somebody else getting fired because there are some firms who are just cycling through tough times and they just keep changing, shuffling the deck chairs, hoping for a different result. So what we look at is whether the predecessor was fired because of performance or because they voluntarily stepped down. It doesn't matter. If you look, the slope of the lines is almost identical. The confidence interval is a little bit larger for non-performance induced because the sample size is a lot smaller, because it was 1.72% performance induced out of 2.5% all turnovers. So there's no effect of predecessors turnover. Finally, we look at how this effect of past performance dissipates over the tenure of a CEO. So if it's truly a learning model, as we get more and more information about a CEO's performance, we start discounting past performance more. And sure enough, we find that the effect of past performance on performance turnover sensitivity is highest in the first year, and then monotonically declines and becomes insignificant after year 4. So all the actions happening in the first 3 years of a CEO's tenure. After 3 years, they've already accumulated enough of their own good information that their prior quarterback or the prior CEO's performance really doesn't matter. Okay. So the next thing we look at is, if there's more career risk, should there be a compensating differential? So if I walk in knowing that my job is less secure, I will demand higher pay. Now, and we find an effect that compensation is higher when past performance is higher. So there is a compensating differential, even though career risk is higher. Okay. So now these are just univariates, and we want to see where the action is. And if you look, the action in a multivariate sense is all in cash compensation, which is short-term payouts, salary and bonus. Salary, there's nothing because almost all the salaries get capped at $1 million. So it's all in the annual bonus, which is your short-term reward. So if you have to get a compensating differential for career risk, you want it to be paid out immediately rather than wait for your restricted shares or options to vest in the future. So there is a compensation differential for the career risk, which is also consistent with the Bayesian learning story, because people expect higher performance. Okay. So in conclusion, and then I'll open it up for questions. Past performance affects CEO turnover, performance sensitivity, because executives are held to a higher standard after following superior performance, because pre-appointment performance in a rational learning story increases expectations for future performance. And our story is consistent with owners learning about their firm's potential value in sort of a Bayesian rational sense. Okay? And that's all I had. And I will open it up for questions.
DJ, thank you very much for the presentation. So our first question is from Doug Hanna. Doug, can you please ask your question?
Sure. I was wondering, the paper says it's about the sensitivity in this relationship, but it seems more like it's just about the level of the hurdle that we have to meet. That is, the role of performance could be playing exactly the same importance in the retention decision, but now the hurdle is higher. So is this a sensitivity decision, or is this just a chance of not making your performance hurdle because your performance was too high last period?
The performance effect is the main effect, right? So in these regressions, so what I want to look at is how sensitive. So if I have a negative 10% stock return, is that considered okay or really bad, and how that changes? If past performance is much higher, then that negative 10% is much worse news than if past performance was already low. That's why it's a sensitivity effect. It's really not a main effect. The main effect is already subsumed at the main coefficient.
But doesn't this seem like the classic budgeting problem?
Which would be?
If I do really well this period, I have to beat it next period to be seen to be doing well.
Yes, so that is the ratchet effect. And the ratchet effect is exactly the same. And so in my past work with Rafi, that's what we did, which is intertemporal incentives, which is, you're absolutely right. The hurdle is much higher. It's essentially, so the analogy I'll make is this, that if the next quarterback for the Patriots comes in and gives them a 500 season, they're probably going to get fired. Because the Patriots aren't used to 500 seasons. They're used to going to the playoffs.
Is there anything
right?
more you can
but
do
if you go
to
to
demonstrate
Cleveland
that
Browns,
this is a different effect? Is
me?
there anything more you can do to persuade the reader that this is a different effect than the ratchet effect?
No, it is exactly the same. But the ratchet effect is slightly different in the sense it's the same person in the ratchet effect. In the dynamic incentives, you are being compared against yourself. So one way to overcome the ratchet effect is to actually have job rotations. What we are saying is, even though it was somebody else, the standard is being set by somebody else. So it's more like a relative performance evaluation story rather than a dynamic incentive story.
All right. I actually had a similar question, put it on the chat. So let me ask you right now. So you're saying that, related to what Doug was just saying, you're saying that what changes is a performance sensitivity, meaning that the likelihood will increase somehow linear of turnover will increase either linearly or maybe in your case log linearly, right, with the performance. But maybe what you find is that is not the effect on sensitivity performance, but rather the level of the expectation. So basically, it says, what I mean, maybe you just need to adjust your performance, right? So to include previous CEO's performance when you calculate your adjusted performance for the current one. Do you see what I'm saying? Basically, you just,
yes, and that's going to be in this in the past performance effect. So if you look at the hazard model, there are three big things. There's your own performance. Unconditionally, if you do badly, you get fired. The company's past performance. So if you go to a high-performing company, you're more likely to get fired. Then there's a third effect, which is if you go to a high-performing company and you do worse, you're even more likely to get fired.
I see.
Okay.
All right. So the next question is from Sundaresh.
All right. My question was basically the same as Doug's. Essentially, no matter who the CEO is, the way your targets are set are typically, just based on past performance. So, this whole, it almost seems like if you can show that the effect on an incoming CEO is higher than whatever it was, like the performance sensitivity was for the previous or continuing CEOs, that might be, kind of a contribution, I think, right? I mean, where somehow you're held to a higher standard than people who just stay on, on the job, right? So is the ratchet effect a little higher if you're the incoming guy, or lower? I mean, whatever it may be, but it seems like, this notion of setting expectations based on past performance is not something that new, right?
True. I think it's completely obvious that you're going to use all information that tells you anything that happens in the future.
Right.
But if you look at these regressions actually control for those that are continuing, because these are basically hazard models. So you have 0 1s on the left-hand side. And so if you don't get fired, you continue, those are the zeros.
And, okay, so the interaction of,
interaction is like you have bad performance coupled with the fact that the person before you was good.
Okay.
Right.
And
so that's the interaction.
Does it matter whether the person before you was fired or left?
That was this chart. It doesn't matter.
Okay. All right. One last thing is, your choice of fundamentals, right? I mean, returns versus fundamentals, and also like looking at the last quarter. I mean, again, it's just a procedural thing, but it seems like, measuring the previous person's performance based on, the idiosyncratic returns in the last 3 months doesn't seem like, way of measuring what exactly that person did, right? For all they
Right.
could have users until the last 3 months.
Right.
So it seems like, what you need, especially with the Tom Brady story, just because he won the last couple of games doesn't mean, I'm expecting you to win every single one afterwards. So it's the history of the person, to me, that, that matters, not just what happened in the last quarter.
Yeah. So which is why we do this.
That's your fundamental data. I mean, this whole past performance, kind of satisfying the reader that the last 3 months is what determines how well a CEO did is, because it's just so important. That's your variable.
Yes, so we do that actually. We look at the average performance over a CEO's entire tenure. We have to do average because the tenures themselves vary. And we also look at 4 quarters of the previous CEO's performance.
No, I'm just saying that's what happens. The main one, right? I mean, it's not an additional test because it's an important variable. That's all.
We can swap it out. The problem is as we increase the time window, we start losing observations because we'll start excluding a lot more firms where you have multiple turnovers within 2 years.
Yeah, but just look at the fundamental trend, in earnings, whatever it may, there are other ways to do it, right?
Yeah, absolutely. Yeah.
Right, thank you. So we have Doug again.
Okay, thank you. I was thinking about your interaction term and thinking that I had a lot of difficulty in trying to figure out what my expectation would be on that coefficient. Because if you simplify it for a moment, just for the sake of argument, as either positive or negative performance, if the guy before me or the woman before me was positive performer and I'm a negative performer, when you multiply those 2 terms, you get a negative number.
Yes.
But you get the same thing if the person behind me was a negative performer and I'm a positive performer. The positive or negative characteristic of this interaction term, I had a hard time weaving it into your story and trying to figure out whether or not it was what you really wanted to measure in this circumstance.
So basically, if you think about performance-related turnover, you can basically imagine this performance IT is negative. You're not going to fire somebody for good performance. right? That would be by definition a voluntary departure. So if it's performance induced, this is negative. Then if I see a negative coefficient, it corresponds to positive performance. If past performance is also negative, then you are actually insured. By insurance, you're less likely to be dismissed for negative performance. Okay. I mean, it is kind of difficult to sort of, this graph. I guess we can multiply the y-axis by -1 and show an upward sloping curve. But it's basically, if you look at the x-axis, this is like a negative for performance-induced turnovers.
Just very quickly, I actually had some similar thought. Would it be nice if you can maybe have a 2x2, maybe summary statistics or something where you have 4 cases, current, past CEO, good, bad performance, right? And see the average likelihood of turnover for these. I was wondering if they have a symmetric, because we kind of, you put all of them together.
Right.
Do they have any symmetric reaction or not?
You're right. Actually, and this is something we should do, is because I know my paper with Shane and Bill, we did this, is to disaggregate performance into negative and positive components and show all the action is happening on the negative side. So it's performance-induced turnover. It's not voluntary departures or promotions, for instance.
Okay, thank you. So next we have Sundaresh again.
Yeah, I was just curious about, whether this increased performance sensitivity is justified or not, right? So if it's an overreaction, let's say, I'm firing a good CEO because my expectations are too high, and if the market understands it, maybe the returns will be a little different. Mm-hmm. And, related, not related, but secondly, your thing is mostly in small firms, you said? Mostly.
I mean, it's in both firms, but for some reason, let me go back.
I mean, no, just qualitative.
Yeah, yeah. If you look at this, so it's more pronounced in small firms. It exists in both. The problem,
Yeah, go ahead. No. So I'm thinking with small firms, financial distress and so on, the duration may be quicker only because I cannot afford to wait long. Mm-hmm. And, related, the survival thing that may be a problem too, right? I mean, most of your effect is in the first year. It could be because, maybe these smaller firms don't survive or, or they have to take this action quickly. They cannot afford to, it's not like Apple where I can give you 15 years to find out if you're good or bad, right?
True. But again, this is all, it's the interaction term we are concerned with. Whether or not you have a trigger finger where you are less tolerant for bad performance at all, and it's a firm effect, that's going to show up in the main effects. So this is essentially just on top of everything else that a firm does.
Right.
Does the past performance create any more career risk? Even though it's not because of you, it could be anybody.
Yeah. Okay.
Thank you. So our next question is from Fabrizio.
All right. A very simple question was, you mentioned something about losing observations if you go further in time and so on. How are you dealing with interim CEOs that stay only 1 or 2 years and this kind of pre-schedule, nothing to do with performance?
We throw them out. So all CEOs that have a tenure less than 1 year, we throw them out.
Okay, that's all.
Yeah, we have to, you're right. I mean, the interim CEOs, it doesn't really make sense.
All right, so the next question is from Ijin Lee.
Hi, my name is Jin Lee. I'm a PhD student at Florida International University. I have a couple questions. First one, that I was wondering, what about the market reaction around when CEO is hired. So maybe you can measure the expectation of market when CEO is hired. So that can be maybe related to that later they can fired or dismissed as well. And my second, should I go a second question, or you want?
Yeah, sure.
Oh, my second question is that what about this if CEO has previous relationship or network with the board members? Maybe that could reduce the CEO's later dismiss, because maybe the board member know the CEO better than that they didn't know before. So for example, maybe they went to school together or they worked together before, then they will have a better estimate how the CEO will do when that CEO is hired. So maybe they can be, the hiring committee might have a better expectation, like maybe more correct expectations. So maybe far away from what CEO actually can do or cannot do.
So let me take your second one first. If there's an effect because of poor governance, that's going to show up in the main effect. That is the raw sensitivity of turnover to performance. So if you have affiliations with directors and they're less likely to dismiss you for bad performance, that's going to be your main effect. Now, holding that constant, what we are interested in how the past performance affects that sensitivity, right? So unless that affiliated relation is correlated with this past performance variable, it doesn't really affect our results. The second thing about market reaction is, this is why we are using stock returns, because the market reaction around CEO hiring is already going to be in stock price. So we're looking at their returns over their first quarter, their second quarter, their third quarter. So these are quarterly returns. So it's already a change variable.
Oh, yeah, but what I meant is like, if like abnormally really higher market reaction for the CEO A versus the CEO B, then maybe their expectation will be much higher. The market's expectation about the CEO is much higher than CEO B,
Right.
but yeah. But
Right.
I guess,
and,
yeah.
But those expectations are also going to be affected by this past performance. So if you're Apple, or if you're Microsoft and Bill Gates steps down and Steve Ballmer takes over, you already know that this is a well-managed, good company. So.
Okay, thank you.
Yeah. Mm-hmm.
All right, so I think one of your co-authors had some questions or requests. Miguel?
Hello, everybody. I sort of have two questions or clarifications. First is, another way to see these turnover models are patients, right? And these turnover models only increase the likelihood of a turnover when current performance is bad, right? So the idea of past performance is that they make the board less patient in the presence of underperformance, right? That's why the negative coefficient is sort of weird to understand. Everything is backwards in these regressions. So can you explain that, DJ, a little bit more? That is essentially the likelihood is the result of multiplying a negative number by a negative coefficient.
Exactly. Yeah. So and part of it is we should have actually reported this as performance, negative performance, positive performance, like Shane, Bill, and I did, because then you'll see that the positive performance is totally insignificant. It's all the negative performance that is flowing through. And then it's much easier to interpret, because then you go negative, negative, positive, which is a higher likelihood, right? Because these are all log likelihoods.
All right,
so maybe in the next version, we should do that split.
All right, so we have Fabrizio again.
Yes, so conceptually, do you guys view the effect as continuous in past performance or driven by the big shoes only? You know, is it only like an excellent performance effect, or is also the opposite, that if you know, the little shoes arguments, so to speak? And of course, you know, what's the empirical implication of what, you know, of this view in terms of the design?
You're right. It is actually the little shoes argument too, because if you look at where we split if you look at the predecessor's performance too. So this thing is monotonic in past performance. So even if you are walking into a company that's doing badly, that actually gives you career insurance instead of career risk.
Okay.
Okay. It's easier to, you know, survive when a company is already a basket case.
But for these graphs, maybe you want to, you know, use something like lowest, right? Local regressions or something, because you're forcing linear nature in this. It may be more of a U shape or something.
These are logs. So basically, because we are looking at hazard regressions, so essentially everything is logged. So if I had to redo this with raw numbers, you'd get an asymptote to 1. So it'll be concave increasing going to 1.
Thank you. All right, so the next question is from Yufei Lin.
Yeah, so I have a question. So if we go back to the model, what really matters is that the firm want to learn about the persistent factor in the firm's performance. So what really matter may be that if the F factor. So could you do some study, or have you shown some results about you have a stronger result when the firm performance is more persistent, but not only more uncertain? Because it's not about this sigma square is high or low, but it's this relative uncertainty that matters.
I guess we could do that. So we have, you know, size, age, dispersion, and errors, but I guess we can add that to, we can look at some earnings-based measures like earnings persistence. It's going to be highly correlated with analyst forecast errors.
Yeah, because I think what really matters is that there's a persistent factor in firm's performance. So
right.
Yeah, so people want to learn from past performance about that persistent performance, not only about managers' idiosyncratic ability. But if that persistent is not shown, I'm not seeing the close link between your results and the model. But yeah, I think that can easily be done.
Well, no, actually, it can't easily be done. We have to be careful here, because over what time period do we measure persistence? Because if we, right, because we have a CEO who's leaving and a CEO who's coming in. Then if there's difference in persistence, is it caused because it's a different CEO, or is it because of the firm's fundamental?
Yeah, totally agree. I feel it's important for you to show the persistence that happens when there is a CEO shift. So that shows it's the fundamental factor that affects the firm's performance, but not about the CEO. So yeah, I feel, yeah, there may be something to be done there. Thank you.
Thanks.
All right, so we're close to 1, but I guess we still can take a couple of minutes since we started later. So we'll go a little bit more over 1. So the next question is from Sundaresh again.
It's just an observation on, you know, going back and forth between market-based versus fundamentals. I'm just curious why you don't use something like volatility for uncertainty rather than, you know, going to forecast errors, especially. I don't think the errors tell you much about uncertainty. I mean, the dispersion is, you know, maybe okay, but, you know, if you want to just stay consistent away from, you know, counting-based variables, you might as well just use volatility.
Yeah, so we had thought about volatility, but there's a slight problem with volatility, which actually my paper with Christina and Roman shows, you get this monotonic decline in volatility. So you get the spike when somebody is hired, and this declines over time. And it's a really good measure of uncertainty, but the problem is it's time varying. And we wanted to kind of get something which is non-time varying. There's some fundamental uncertainty about a firm which is persistent because we don't know enough about it.
Yeah, but is it the change in uncertainty that is important? Like, for example, if you use it and there's not much change pre and post. Is it the level of uncertainty that is driving this, you think? Or is it, if I create uncertainty, then,
I mean, if I had to be a purist and stick to the model, this sigma square is uncertainty about the firm.
Right.
It's uncertainty about F.
Mm-hmm.
I don't want it to be uncertainty about AI.
Okay.
So if I look at return volatility at appointment, a lot of it is being driven by uncertainty about AI.
All right.
You see what I mean? I don't know. I don't know what the right way to kind of do it with a market-based measure.
Yeah, I'm just saying it kind of sticks out when everything else is market-based.
Right.
All right, thank you. So our next question is from Shu Jiang.
So DJ, as a theorist, I really appreciate you putting a small model in front of your results. So I just have like 2 comments. So first thing is, if I take your model as a good description of the real world, then one of the implications is that if the firm has less uncertainty about the manager's ability, then your effect would be weaker. Because essentially what you're having is you're trying to infer the manager's ability from by trying to control for this firm factor.
Mm-hmm.
So let's say, for example, if it's internally hired CEOs, then maybe firms have more certainty about their ability, then your result might be weaker than externally hired CEOs. Things like
so let's go back to this. So if you look at this regression, so your claim is about outsider CEOs, right? So in this regression, we are only focused on this interaction term, but you can also look at the main effect. Okay, and the main effect is that if you're an outsider or insider, it doesn't really matter. Your performance turnover sensitivity is the same.
Okay.
Right.
But the performance sensitivity might be fine, because for your model, the focus is on how sensitive the let's say the turnover to performance is to past performance.
Right.
That's the one, because pay performance sensitivity is, it could be, it definitely determined by the CEO's ability. It could be determined by other factors. But like your story about the sensitivity of turnover versus past performance, versus turnover versus performance sensitivity, how that depends on past performance, it really depends on how much you know about CEO's ability.
Yeah. So that was that's in. I don't have those slides with me, but my paper with Shane and Bill, that's exactly what we studied, was how you learn about managerial ability. And we show that the learning curve is steeper for outsider hires than insider hires.
Okay.
Okay. But over there, we do for the same CEO over their tenure.
I see.
Whereas over here, we're only looking at switches between one going out, another one coming in.
Okay.
You're right.
Yes. Yeah, sure. Can I just, the second point is, like in your model, you assume the CEO's ability and the fixed firm factor is independent, at least in the way you solve it. But it doesn't need to be, because your implications is broader than that. Because what you can say is a high performing past performer not only generates high performance, generates a higher benchmark, but it also creates the factor. It's like the firm factor is created by that star CEO, and that is there. That provides, let's say, infrastructure for future CEOs to succeed. And therefore, that's why if your performance is not good enough, that means you're not taking advantage of these infrastructure in a good way. Then then you should be terminated more. So, you know, I know for modeling purposes, you have to, you have to go simple, but your implications are broader than that.
Yeah, well, this is just the most parsimonious representation we could find. It's additive, but it's a little more general than just being additive. So if I assume that F is a marginal productivity of a CEO, so I assume that this is a multiplicative. So firm value is AI times F.
Mm-hmm.
But then if I take logs,
yes,
I go back additive. So you can kind of consider this to be, in that world, this could be logs.
mm-hmm.
Log AI plus log F.
Yeah.
Okay.
That's right. Yeah.
But
just a comment. Yeah.
I kind of need additivity to get to Bayes' rule.
Mm-hmm.
Because I need normality or some kind of Gaussian thing going on.
Mm-hmm.
Because otherwise I don't know how to do conditional expectations when the distribution becomes something else.
Yeah. That's right. Yeah, just comment saying that, you know, your implications is you know, is much broader. Yeah. Okay, thank you.
Mm-hmm.
Right, so we'll try to quickly take 2 more questions. One is from Doug.
Hi again, DJ. In your model, you explicitly model F as a variable that we're updating on in a Bayesian fashion. Are we not also learning about A in a Bayesian fashion? And should that not be modeled as well?
Yes, but if I take the conditional expectation of AI given VI minus 1, it's going to be 0 because AI and AI minus 1 are uncorrelated.
It just strikes me that there seem to be some error terms in here that might be missing. Because if I'm learning about something, I'm not observing these actual variables, I'm getting signals about them. And both the signal about A and the signal about F probably have different errors built into them.
True, but since we are looking at how past performance pre-appointment, that past performance due to the previous CEO's ability is uncorrelated with this CEO's ability. So it's kind of like saying Steve Jobs is gone. Steve Jobs' ability has nothing at all to do with Tim Cook's performance. So, but the only thing that remains,
that past performance with error, right?
Right, which is the error term.
Well, is it that error term, or is that error term capturing something else?
Oh, we can make as many error terms as you want, because the only thing we care about is this sigma square, which is the variation in F, which is time persistent, versus sigma epsilon squared, which is the total variation. So I can add as many error terms as I want.
Okay, I was explicitly thinking about an error term in our understanding of A.
True. And if there was any kind of correlation between AI and AI minus 1, then we'll update on AI. But over here, we particularly looking at somebody's leaving. They are gone. Now a new person comes in. It's a different person. So their abilities are uncorrelated.
All right, I think we'll take the last question from Shane now. Thank you, Doug.
Just quickly, DJ, fantastic slides, by the way. They're an inspiration. I'm going to use that, that black background. Looks great. There's a paper, Cheng Hayes and Hillergeist had this paper in Management Science. I noticed you guys didn't cite it. I don't mean to blindside you or anything like that, but they show in that paper that financial distress creates this compensation premium. And so I think that's inconsistent with what you guys are showing with your comp, right? Because you're showing higher expectations leads to higher comp, or is associated with higher comp. Is that right? Yeah, with the bonus.
Yes. No, you're right. It's coming through bonuses.
Yeah. So it would be interesting to just try to reconcile that, I think. Yeah.
Now, the one thing I would say is we probably don't have a lot of distress in here, because remember, at least for the Genta and Llewellyn and Perino stuff, we throw out M&A and spin-offs.
Okay. So Yeah, and they do focus, as I recall, predominantly on forced turnovers because of the company not doing very well. So you might not have a lot of those in your sample, actually.
Yeah.
So they were focused only on new CEOs or new CEO appointments to try and disentangle the performance effects from the ability effects.
Right.
Anyway, it might be something to look at because it seems related.
So this is what is this, Cheng and Hillergeist?
Cheng Hayes, Rachel Hayes, and Steve Hillergeist. Yeah.
Okay. Thanks. Look it up.
All right. Thank you, DJ. And also thank you all for joining our seminar. Hope to see you guys next week. We apologize for the technical issue we had with the link. That won't happen again. Thank you. Have a good day.
Thank you, everybody.